Thank you for joining us for what we're confident will be a very educational, informative, and most importantly, very valuable investment of your time. Before we get started, we always have to start with a disclaimer. Past performance is no guarantee of future results, and any vehicle mentioned today is only available via the limited partnership agreement and the private placement memorandum. So today what we're going to talk about is how basically not all credit is equal, the investor's dilemma that we see in the marketplace today, and our approach to how we potentially can solve that, and basically do what all business is really about. So the first thing we want to cover today is how not all credit is equal. Private debt has outperformed public debt by dramatic margins over long periods of time. As a matter of fact, over almost every single time frame you can possibly compare it to, private debt has outperformed dramatically. The reason it has done that is because of just some structural advantages that you see in the private markets. Now, obviously, if you're going to give up liquidity, thus the term private, you should get paid a higher rate of return than if something is totally liquid. But because of these other structural advantages, such as customization and not as much competition, you really expect much higher returns, and obviously history has shown us those returns have come through. One of the main reasons for that is the benefits of a floating rate coupon. What do we mean by that? In some loans you make, like you think about a mortgage, you have a fixed rate on a mortgage, or you can have an adjustable rate on a mortgage. Well, obviously the lender in a fixed rate knows exactly what they're going to make, and they're not going to make anything different. Whether rates go up or down, it's fixed. But the advantage of having a floating rate as the lender, it protects you from rising interest rates, but in most cases, you also have protection against falling interest rates. So you kind of get the best of both worlds. And we are expecting enormous growth in the private credit markets between now and 2028. It's expected to be more than $2.7 trillion over that time frame. And there's a lot of tailwinds that are causing this. First of all, market uncertainty. Anytime the world, the economy, or markets in general get uncertain, we tend to see really unique opportunities in the private credit market. A lot of the banks are having to pull back because of reasons that are outside of their control. So what they've done for the last 50 years, they just really can't do anymore. The other thing that's really advantaged is these lender economics because of what we see in the marketplace and this flight out of the banks, or what's called the disintermediation of the banks. You're seeing much better economics for the lenders. So the benefits for you as an investor in private credit is that you have very little correlation to the public markets. You don't have to worry about necessarily this zigging and zagging with everything else in your portfolio. You get significant diversification because in a custom design, you can really choose where you want to have your exposure. You can diversify asset class, sector, vintage, all types of size, and certainly different stages of the life cycle of a business. And we believe that private credit has an enormously superior risk-reward profile. More return opportunity with less risk. That's always a good combination. So one of the other benefits of the floating rate nature of private credit is you actually benefit from higher interest rates. So think about it this way. You make a loan to someone at a spread over the T-bill rate, and the T-bill rate was at 0, just to keep it really simple. And you say, I'm going to lend to you at 5% more than T-bills. Well, obviously you're going to make 5% on your loan. But if the Federal Reserve comes out, like they have, and raised rates dramatically, then let's just say they raise it by 500 basis points or 5%. Well, now you're getting 5% plus 5%. You're getting 10%. And you are literally making the same loan to the same borrower, and you have virtually the same risk against the same asset. That's a much higher return for you. But also these are typically structured with floors, meaning that if rates start to fall, you have a minimum guaranteed return or a minimum coupon that you're going to receive. Now, the interesting thing about the world today is there's a new need that has been created. And those who fill that need have the opportunity to generate very strong risk-adjusted returns. Now, many of you that watch this video have seen this chart before. The growth of the private markets has been massive. It doubled from 15 to 21. It's expected to double again, basically in the next 6 years. The lack of harvest, though, has created an interesting new need for liquidity. Now, what do I mean by that? Well, obviously, if a lot of money has been put to work in the private markets, and a lot of people that have never done it before, they obviously are not as used to what happens in periods where distributions slow down. So what this chart shows is how there's been enormous growth of funds, there's been a tremendous amount of calls for those funds, but the distributions have actually come down. So for the last 5 years, to be very direct, people have put out more money out of their left pocket than they've received back into their right pocket. So their net out of pocket for the last 5 years has become pretty significant. Well, that's not always the way it works. In many cases, you get more money back than you actually deploy. Well, obviously, it's then funding itself. Well, if you have a lot less money coming back to you, well, then you have to get it from somewhere. Well, that starts to create a liquidity squeeze. Maybe not after 1 year, but after 5 years, you start to feel that pinch. And so a lot of the funds that have been raised in the last decade have a very significant investor base that are really looking for ways to create liquidity and to monetize their unrealized value. So this has created a dilemma for investors, and nobody likes being in a dilemma. But so many of these investors in these funds must now decide, what are they going to do with these assets that are taking longer than expected to harvest? They may have to take care of an obligation, maybe make a capital call or desire to make other investments, or any other multitude of reasons why they might want some liquidity. And obviously, if these assets were just publicly traded stocks or bonds, they could easily sell them, or they could at least get a margin loan. But private assets are different. Now, obviously, wherever there's a dilemma, wherever there's a problem that needs to be solved, those that solve that problem have the ability to add a lot of value. And in this situation, investors just don't have a lot of choices. So naturally, anybody who helps solve that problem for them are likely going to be rewarded very well for doing so. Because the options for the investors are really limited. Let's just take an example of a fund that they're in, and they've got future commitments to that fund. Well, if they don't have any cash or they don't have enough liquidity, they can default on their commitment. But oh my gosh, that is so painful. It's extremely punitive and it will destroy capital. They can try to sell in the secondary market, and that might work for them, but they're most likely going to have to sell it at a loss, and they're not going to participate for sure in the upside from the investment going forward because obviously they won't own it anymore. They can try to borrow from a bank. Now, usually what happens is they have to put up significant cash collateral, which kind of defeats the purpose, or a personal guarantee, which doesn't feel very good. And that's if the bank will loan them the money at all, which leads to a very different environment we see today. We have a disrupted lending environment. There's two main reasons for this. The first is that the regional banks and the normal banks that would make these types of loans to an individual or even institutions or funds, there are just not as many of them. So since 1985, there's been a 72% decrease, shrinking of the number of banks, community banks in the United States. That's a huge decline. But it's not just that some of them have gone away by being acquired. Some of them have just gone away. Silicon Valley Bank, shut down by the FDIC. Signature Bank, shut down in 2023. First Republic Bank, gone. Just closed its doors after being shut down by regulators. So when you add all of that together, there's just not as many options for investors. So in addition to so many of the banks just leaving the market, the banks that still exist today, they've got a problem. Most people are not familiar with this, but regional banks and community banks are actually the largest lenders for commercial real estate. And we all know about the challenges that are facing that sector. If a large portion of the loans that you have made are under a lot of pressure or they have a lot of risk, as a bank, you're not going to be able to make a lot of loans you might want to make because of that pressure. So somebody can come in and fill that need with what's called NAV financing. I'm going to define that for you a little bit. Net asset value, which is the value of the asset, also known as NAV. NAV financing is where a lender provides money to an owner of an alternative asset. And the collateral is the asset itself, the net asset value of the fund or the specific asset that the borrower owns. Net asset value financing, NAV financing. So the difference between NAV financing and a lot of other types of loans you're probably familiar with is that typically the loan-to-value ratio. The loan-to-value ratio, the LTV, is the ratio of how much loan compared to the value of the asset. In the world of NAV financing, it's typically much lower than the types of lending you might be familiar with. So let's use one example, real estate lending. Now, most everybody's familiar with real estate loans. So let's take a typical transaction. Somebody buys a real estate asset for $5 million and they get a loan to value, a loan of $3 million, which is a loan to value of 60%. $3 million divided into $5 million, 60% loan to value. And let's just say the interest rate is 8%. Well, obviously in year one, the borrower is going to pay $240,000 in interest. Year two, $240,000, year three, $240,000, but then life happens in year four. And unfortunately, they can't pay it anymore. The bank has to foreclose on the asset, and then the bank liquidates it. Well, that's not a good outcome for the borrower, obviously. But let's look at what happens for the lender. Let's just say very conservatively that the lender sells the asset at a 40% discount, where literally they sell it for $3 million. Well, they made a $3 million loan. They sold it for $3 million. Obviously, they broke even on the loan itself, but they did get the interest that was already paid. So just to keep it simple for the video, we're not factoring in those expenses. But so the interest that was earned, 3 years at $240,000, that's $720,000. So the profit when the bank is fully complete with this transaction is a profit of $720,000. That's a return of a 1.24x multiple on their money and an internal rate of return, or an IRR, of 6.17. Certainly not a great outcome, but for something you had to take back, that's not a terrible outcome. Let's look at NAV financing. Typically, NAV financing has a much larger margin of safety. So let's look at a very similar example, $5 million asset value, but instead of a 60% loan to value, it's a 30% loan to value. So only a $1.5 million loan against a $5 million asset. And because it's unique, the interest rate's going to be a little higher. So in this illustration, just 10%. Same result. Year one, $150,000 is paid. Year two, year three, $150,000 each. And then life happens and somebody cannot continue to do that. They have to be foreclosed on the asset. But now let's look at what happens for the lender. Again, not a good outcome for the borrower, and nobody ever wants this to happen. But if it does, then what happens for the lender? In this case, assume even a more conservative scenario. The lender sells the asset at a 50% discount. So $2.5 million is all they get on something that was worth $5 million. Well, the lender still recovered $450,000 of interest, but now they actually make $1 million on the disposition. So the total return is a $1.45 million profit on a $1.5 million investment. Well, that's almost a 2x multiple on the money and a gross internal rate of return of more than 20%. Again, nobody ever wants this to happen, but life does happen. And if it does happen, NAV financing has such a good cushion that it actually can be a very positive outcome for the lender. So how can you benefit from this trend? Well, first thing is find a way to fill that need by increasing the opportunity set for people that need liquidity to be able to actually access that liquidity. Now, the key is you got to create a lending structure that is customized to be very fair and good for both the borrower and for you as the lender. But then you also need to figure out a way to get a very significant amount of origination. Where are you going to find these people who want to borrow? Where are you going to go if you have to sell an asset very quickly that you take back? And you also better know how to underwrite all of the various things that you're going to look at and decide what loans to make, what loans not to make.